Okay, good morning, or good afternoon, I guess. My name is Rachel Bubb, and today we are here to talk to you all about Roth IRAs and to see if it's an appropriate investment for your retirement nest egg. So with us, we have Diana Saylor and Carrie Bubb, both financial advisors here at the firm. And just so you all know, from some housekeeping items, this webinar will be recorded. And throughout the webinar, if you do have questions, please, we want to hear your questions or we want to see your questions, but type them into our Q&A box. If you pull up your Zoom, control panel, you'll see the Q&A. That's the place to type in your questions, and we'll make sure we get to those at the end. That would be the best place to do it. Please don't type into the chat. And then there should be a poll that popped up on your screen. Please take the time to answer those two questions, and we'll make sure to answer those at the end as well. So with that, I'm going to pass it over to Carrie and Diana.
Hey, Rachel, thank you for that introduction. And today we're going to talk about Roth IRAs, which is a subject that is very near and dear, to my heart. And I think to really understand the Roth IRAs, you have to go back and understand a little bit about the traditional IRAs and what happened. So in the mid-1970s, actually through early 1980 or so, Congress had enacted legislation which allowed employees of corporations that did not have a retirement plan to put $1,500 a year away and actually take a tax deduction. And this went on until about 1981, and then it was expanded in the Economic Recovery Act in 1981, which then established the tax-deductible individual retirement account for all people, where they could put up to $2,000 a year and take a tax deduction for a working person, and for a non-working spouse, they could put that $250 a year away. Well, that went fine from about 1981 to about 1986, and then due to budget constraints and other issues, the tax deductibility of the IRA was changed for many people. And basically what Congress did is they decided to phase it in and out based on income levels, based on if you had a retirement account, based on whether your wife worked or not, and a whole other thing, and a bunch of things. And those laws stayed pretty consistent all the way till about 1996. And then in 1997, along came Senator William Roth, a senator from Delaware, and introduced what we now know as the Roth IRA, named after him. And Senator Roth really wanted to encourage young people to save and invest for their future. And so what they did is they changed a few things on the Roth IRAs to make it more palatable for younger people. But the big difference is that in a Roth IRA, you no longer receive the tax deduction, but what you did is you put after-tax money into the account, but ultimately, depending on the rules, everything could come out tax-free. So because there was no upfront tax deduction, it had no economic impact on the U.S. government balance sheet and income, because there was no deduction up front. And so the Roth was born. Originally, it was allowed to put $2,000. Today, in 2021, if you're under 50, we're allowed to do $6,000 and $7,000 if we're over 50. So what started out as a tax deductible thing emerged into an after-tax account, which ultimately, if done right, can be a tax-free account. So pretty exciting.
And as Carrie mentioned, a Roth IRA is an after-tax retirement savings vehicle that grows tax-free. And there are a couple of ways to fund a Roth IRA, and we're going to get into the details of both methods. First is a direct contribution, and second would be by way of conversion. Carrie, can you go over the income limits and the contribution limits for us?
Yes, absolutely. So Congress never likes to make it easy. So what they did is they had phase outs and phase ins, and depending on your age and whatnot. And we simplified the data a little bit for just today's meeting. But basically in 2021, if you're married and you're filing jointly, and between you and your spouse, you make less than $198,000, and you have at least 6 or 7 or 14 or 12, depending on how much you want to put away, then you can contribute, $6,000 for each of you, a total of 12. If you're both over 50, then a total of $14,000. So again, over 198, it phases out. So at about 203 or 208,000, you are not eligible whatsoever. And basically, if you're single or filing head of household, if you make less than 125,000 in adjusted gross income, then you're eligible to contribute up to 6 or 7, depending on your age, as long as you have the earned income, the wages. And then Congress, for some reason, doesn't like people that are living together filing separately. So they get phased out at only $10,000. So not much opportunity for them. But definitely Roth IRAs, know the income limits and take advantage if you can. And one of the questions, well, who should contribute to the Roth IRA? I get that question all the time. Well, of course, you have to have wages because that's the key requirement to make a contribution. And I think the people that should consider this are those that have already taken advantage of their other retirement vehicles. So maybe you have a 401k, you're an Edison employee, maybe you're a policeman or a sheriff and you have deferred comp or 457 plans. So you should be doing and maximizing those other vehicles really to their fullest extent. But then if you have excess savings and you're trying to build a better retirement nest egg for yourself, since you're not eligible for other traditional IRA deductions, now the Roth is a great place to park that excess savings so that it'll grow tax-free. And anybody that believes that they're going to be in a tax bracket in the future. So if you think when you retire, you're going to be in the 10%, the 12%, 20, 24, boy, fund the Roth IRA, because when that comes out down the road, that's all tax-free. 0% tax is better than 10 or 12 or 24 or 35.
So now that we've defined the direct contribution way into the Roth IRA, let's get into conversions. What are they? So basically, it's when you have pre-tax funds in a traditional IRA and we move whatever amount we want. There is no income limit, and there is no limit on the conversion amount. There is no income limit. Everyone is eligible. So it really just depends on what amount you want to convert to the Roth IRA. But you must be willing, whatever amount you do convert in that tax year, you have to be willing to pay taxes on the amount converted. And what we recommend is, first we need to determine, what the potential tax liability on that conversion is, and do you have the outside funds to pay for those taxes? We do not want to take additional funds from your pre-tax account to pay those taxes. So again, everyone is eligible, whether you're working or not, any income limit, then there is no limit on the amount converted. You could convert your entire IRA if you wanted to, but you must be willing to pay the taxes. And who should convert? We do get that question a lot. First and foremost, we just have to make sure that you're willing to pay the taxes from savings that you have. So that's first. And then maybe you believe that you'll be in the same or higher tax bracket in retirement. You believe tax rates are likely to rise. You'd rather pay taxes now and enjoy all gains tax-free, and we'll get into that in a second. You have no need for the full required minimum distribution amount at age 72. And if you feel it's important to leave tax-free assets to your heirs.
So there's two types of monies in these Roth IRAs. There's the contributions, and that's what you've either made contributions or even the conversions amount. So these are monies that you basically paid the taxes on. The other type of money is the earnings, and so that's what we hope to accumulate. Well, the contributions from a regular contributory Roth, you can take that money out at any time without any penalty at any age. And that was one of the big things that Senator Roth wanted to do, because a lot of time young people in the 30s or 40s or 20s didn't want to make that long-term commitment. So if you put $6,000 in this year, $6,000 in next year, and 2 years from now you needed the $12,000, it doesn't matter. You can draw the $12,000 out without any taxes or penalties at any time, at any age. The earnings, though, there's a couple rules. If you want to get the earnings out, then at least 5 years must have passed since you first opened the Roth contribution and made your contribution. And then after you've met that first requirement, at least one of these others need to apply. You have to be at least over the age of 59 and a half, then it's all tax-free, or you are purchasing your first time home and you can pull up to $10,000 out of the Roth IRA, even if you're not 59 and a half, to buy that first home, or if something sad happens and you're either a death or a disability, then of course the earnings are tax-free as well. So contributions anytime, earnings, you just have to play by a couple of those rules, be over 59 and a half for death or disability. As long as you've had the account 5 years, everything is tax-free for the rest of your life. It's a pretty neat story.
Let's get into some advantages of the Roth IRA. First, distributions are tax-free, so they do not increase your adjusted gross income. Second, transactions inside a Roth IRA, so whether it's interest or dividends or capital gains, transactions inside a Roth IRA are not taxable. If a Roth IRA owner dies, the spouse is permitted to combine Roth IRAs. If the spouse already has one and they inherited the deceased spouse Roth IRA, they can combine that for consolidation purposes. Assets in a Roth IRA can be passed to heirs tax-free, like I mentioned earlier. Now, this is definitely something to consider if you want to leave assets to your kids. You know, the laws have changed over the past couple of years. In the Secure Act, what has happened is the rules for inherited IRAs, now the heirs must distribute the entire balance of the account over 10 years' time. So if you have a large pre-tax account and your kids inherit it, they would be forced to distribute those funds over 10 years' time. So if it's important to you to leave assets to your heirs, you know, maybe considering a conversion, because then they would inherit tax-free dollars. So that's one thing to consider. Another advantage is the effective contribution limit. So Roth IRAs technically have a higher effective contribution limit. So if you're under 50, you can put in $6,000 into a Roth IRA as well as a traditional IRA. So $6,000 is the limit. But if you look at the effective limit, so let's say your tax rate is, you're in the 25% tax bracket. Your effective contribution limit then for the traditional IRA would actually be $8,000, but you can only put in $6,000. So they're basically saying that the Roth IRA has a higher effective contribution limit. Funding Roth IRAs can possibly reduce estate taxes. So if let's say you converted to a Roth IRA and you used some of your cash or savings to pay the taxes on those monies, then essentially your estate value may go down a little bit. You're paying the taxes, you're prepaying the taxes on the Roth. Roth IRAs can diversify tax risk. And distributions, like I mentioned earlier, they do not affect your adjusted gross income, and thus they do not increase the taxable amount of your Social Security benefits. Carrie, are there any disadvantages of having a Roth IRA?
Yeah, I'm hard pressed to find, I guess, the disadvantages. And I think one of the challenges as we grew up throughout our years, we're always thought, well, you know, defer as much as you can and we'll kick that can down the road. And so the biggest disadvantage is getting your head wrapped around, well, why should I pay taxes today if I can put them off until tomorrow? And I think that's where you have to do a little bit of math and kind of analyze your situation. But, you know, the biggest negative is you're having to pay the taxes earlier, but the carrot is you get all the earnings tax free. And so if you have time on your side, if you have assets that you don't currently need to live with, or to maintain your lifestyle, then paying those taxes today, while it might be a kind of a disadvantage, it's kind of, again, as you say, paying taxes on the seed and not the harvest. And I know you're going to say that in the next slide. I think the other thing is when you make contributions to a Roth, you know, that does not reduce your current taxable income. So a lot of people will say, well, if I don't get a tax deduction, why do it? Well, the reason you do it because, again, you get all those earnings after 15 or 20 or 25 years, depending on your horizon, tax-free. I'd rather pay the taxes now to have the benefits later. Another thing we hear is, well, Carrie, what if laws change? What if they make the rules all different? You know, that's certainly something that we can't predict for certainty. But we do know that historically, whenever they have changed rules, they tend to grandfather them. And so if you did and put in money based on the rules at this point, and later they changed the rules, well, you know, no longer could you do it. But you would still be allowed to take the distributions the way the law was designed at the time. And then the other thing to consider is, you know, depending on how much you convert and how excited you get about it, you have to be aware that conversions add to your AGI, which may increase the Medicare Part B premiums that you pay. And those are based on your adjusted gross income. So before you rush off and convert too much, we want to do a little tax analysis to see if that makes a good sense for you. So disadvantages, yeah, just having to pay the taxes today when we've been taught all our life to, you know, push off the taxes as long as we can.
And earlier, Carrie went over the income limits for those who can contribute directly to a Roth IRA. And there actually is another way of contributing to a Roth IRA, and this would be for the higher wage earners. So this is called the backdoor Roth IRA. It's not a different type of Roth IRA, it's just a different method of getting funds into the Roth IRA. So how it works is you would open up a traditional IRA, make a non-deductible IRA contribution, and then immediately convert it to the Roth. So it's a two-step process. There's additional documentation, paperwork, extra filing form come tax time, but definitely well worth it, especially for those higher wage earners. Now, it's not for everyone. We do not recommend that you take this approach if you already have assets in a traditional IRA or a rollover IRA or SEP or simple, because what happens is if you already have an existing accounts with funds and you make a non-deductible contribution and try to just convert that non-deductible portion, the IRS says no. It's called the pro rata rule, and basically they would force you to pay some tax on the existing pre-tax assets that you have. So we just recommend usually that you set up every year, you have to set up the traditional IRA, make the contribution, and immediately convert. But at least it's a strategy that's here. There has been some concern that it might go away at some point, but actually Congress just recently gave their stamp of approval on this approach. So hopefully laws won't change, as Carrie referenced earlier, that can happen, but it's here for right now. So maybe it's a good strategy for you.
Yeah, so we always get this last question. Well, how do you invest a Roth IRA? What can I earn? What's my return going to be? Well, the Roth IRA, as far as investing, is very similar to the traditional IRA and many of your 401ks. You can be as aggressive and invest in stocks and international things, or as conservative, invest in money markets and fixed income. Generally, we encourage people to invest Roth IRAs more assertively because remember, it's the earnings that are tax-free. The principal that you put in, the contribution, the conversion amount is your money that you've already paid tax on. So really to benefit from this, it's the earnings. And the best way to maximize the earnings typically is to be more assertive and willing to, I guess, tolerate risk and volatility. But of course, you know, it's your personal choice. It's up to you. But generally the returns can be as good as you want, you know, based on the risk that you take and the time frame. And so we normally encourage Roth IRAs to be invested a little bit more aggressively, maybe than your traditional IRAs and other things that you plan on using maybe in retirement where this money might not be used till later as rainy day funds or something fun like a new RV or something like that.
Great. We've gone over a lot today, so we wanted to give you a few key takeaways. First, you should definitely consider funding a Roth IRA as part of your retirement strategy. Consider paying tax on the seedlings so you can accumulate a tax-free harvest like Carrie mentioned earlier. And even if your tax rate may be lower in retirement, you still should consider funding a Roth IRA as additional tax-free savings. And lastly, you should consider converting, especially between retirement and age 72. And so really what we like to do, if you're an existing client, we usually always talk about Roth IRAs or conversions and do a tax analysis in your goals and planning session. If you're new to us, we're happy to talk to you and see if Roth IRAs or conversions are appropriate, but every case is different. And so we can just have the discussion and see if it's appropriate for you.
Sounds great. Hey, Rachel, how about those poll results? Did people get the questions right? And it looks like we have a couple questions out there.
Yeah, so can you see the results?
So contributions to a Roth IRA can be withdrawn anytime without penalty. The answer is true. So remember, it's contributions. We're not talking about the earnings. So any money that you put in can be withdrawn at any time without penalties or taxes for that matter. So the minority got that one right. So as far as the last question, what amount of your IRA is eligible to convert to a Roth IRA? 58% of the people got that right. It's unlimited. You can convert your entire IRA account if you're willing and have the wherewithal to pay all the taxes. So hopefully you learned some information today after attending this webinar.
Okay, so for questions, we have one. Does Social Security count as income? This person, she is retired and has a monthly salary that she's receiving from KWB.
Okay, the answer is yes. It does count as income. Typically, it's either 50 or 85% of the Social Security benefits would count as income, calculating the AGI, adjusted gross income, based on the rest of the situation. So if you're single, I think it's, is it 25,000, and then over 32, 85% of your Social Security is counted as income in this conversion process. And sometimes it can make us pay taxes on Social Security where previously we hadn't. So we would definitely want to look at that very closely before that decision was made.
So this person, they make $248,000 with their wife last year. So he's saying he doesn't qualify for a Roth, but should he do the traditional then?
And the answer to that would be, when we talked about the backdoor Roth approach, so you would be eligible to go about it that route. So again, it would be establishing a traditional IRA, making a non-deductible contribution, and then immediately converting. So you would be a good candidates for the backdoor Roth approach. So we're happy to talk to you about that.
Yeah, that's unless, oh, go ahead.
The only where if that it would be an issue for this person is if he had existing
Yes.
IRAs or things like that, or SEPs, then the backdoor approach is more challenging and it might not work. So one of those we'd have to look into.
Right.
And there are options with the, if you do have existing IRAs, you can roll those into maybe a employer sponsor plan that you have. So that opportunity, there is ways to kind of get around it, but it is just an account consolidation process to make sure that you can do that backdoor approach.
Absolutely. And the other thing with the person making over 248,000, kind of depending on viewing how his taxes are, we didn't get into this today, but there are also things called Roth 401ks. So at your employer, you may be eligible to put money into a Roth 401k. And so you have to decide, well, do I give up a tax deduction today and I'll put my 19,500 or 26,000, whatever you're eligible for, and then do it on a post-tax basis. I personally do that because I think, taxes aren't likely going down. I'd rather go ahead and pay the taxes today on that Roth 401k contribution so that all that money comes out tax-free down the road. So, it doesn't have to be all or nothing. If you are employed at a place that has a Roth 401k, you could decide, well, I'll put 15,000 in my traditional and get a tax deduction, and the other 11,000 if you're over 50 in the Roth, and kind of, do a little bit of pay tax on some now and defer some as well.
What about a strategy to maybe if you converted a big portion of your IRA, but then, you're still earning income, and so subsequently you decided to add to your traditional 401k, can you still take that deduction from, your 401k contribution, and that can counteract your conversion?
Yes, and I think I know what the question is. So yes, you can simultaneously contribute to your 401ks while you're simultaneously converting, allowing you to get more money into both, vehicles, absolutely. And that's probably one where you'd have to kind of have more of a one-on-one discussion to really understand what the person is trying to achieve.
Thank you, everybody, for joining us today. If you do have questions that pop up later to you, or you do want to sit down with an advisor and talk about the potential for Roth conversions or backdoor approach for you, please reach out to anyone here. You can email invest@kwbwealth.com, or you can email your individual advisor, just their name, like Carrie@kwbwealth.com or Diana@kwbwealth.com, and we're more than happy to help you guys. So thanks again.